Hi guys, this is Econoscope. Your front row sits to the global economy. CBN holds interest rates at 26.5%. What does it really mean for your wallet, your business, and Nigeria's economy? Part 2. Nigeria's cash reserve ratio, CRR, is extraordinarily high. Nigeria's CRR is 45%. That is among the highest anywhere on earth. Let's compare. United States around 0% formal reserve requirement. The Federal Reserves abolished reserve requirement in 2020. Eurozone around 1%. United Kingdom no formal reserve requirement. Japan close to 1%. South Africa about 2.5%. Nigeria 45%. That means Nigerian banks have far less money available to lend than banks in most advanced economies. It is an extraordinarily restrictive monetary setting. What is the Standing Facilities Corridor, SFC? Another key decision was retaining the Standing Facilities Corridor at plus 50 and minus 450 basis points around the MPR. What does that mean? Think of the CBN as the bank of banks. If a commercial bank suddenly needs cash overnight, it can borrow from CBN. If it has excess cash, it can deposit it with the CBN. A basis point is 100th of 1%. So 100 basis points equals 1%. With an MPR of 26.5%, banks borrowing overnight from CBN generally pay about 27%. 0% MPR plus 0.5% percentage point. So banks placing excess funds with CBN generally earn about 22%. MPR minus 4.5%. So this corridor helps the CBN manage short-term liquidity and keep market interests aligned with its monetary policy objectives. So what is the 75% CRR on non-TSA public sector deposits? This is one of the least understood policy tools. It is even more restrictive. First, TSA means Treasury Single Account, a system that requires most federal government revenues to be consolidated into a single account at the CBN. Government agencies sometimes keep money in commercial banks outside the Treasury Single Account TSA. However, some public sector funds remain outside TSA. These are known as non-TSA public sector deposits. For those deposits, CBN requires banks to keep 75% as reserves. Here is a simple example. If a bank receives 1 billion naira in eligible non-TSA public sector deposits, it must keep 750 million with the CBN and can use only 250 million naira. Why? To prevent large government deposits from flooding the banking system with excess liquidity, which could fuel inflation, increase speculative demand for foreign exchange, and weaken monetary policy. Why did the CBN hold everything steady? Why? CBN cited several reasons. One, headline inflation eased only marginally from 15.93% in May to 15.91% in June. Two, monthly food inflation accelerated from 2.98% to 3.75%, showing that food prices remain under pressure. So three, renewed conflict in the Middle East has increased uncertainty in global oil and energy markets, with the risk of higher shipping costs and imported inflation. So, in short, CBN believes inflation is improving, but not enough to justify lower interest rates. So, global risks also matter. Nigeria does not operate in isolation. The world is becoming increasingly unstable. Middle East tensions, oil price volatility, shipping disruptions, Strait of Hormuz. So higher insurance costs. This all influence inflation. If crude oil suddenly jumps above $100 again, imported inflation returns. Nigeria pays more machinery, pay for more, Nigeria pay more for machinery, pharmaceuticals, aviation fuel, fertilizer, and industrial equipment, which then pushes prices higher. The CBN wants to prevent that spiral. So, this is where we'll stop. In part 3 of this series, we look at other factors. Thank you for listening. Bye.